Do you remember in 2014 or 2013 when you bought your PS4? Exciting times. You had paid about what? 399 US for it, right? Now fast forward to 2020. You want to sell back this PS4, but you can't seem to get more than 199 US for it. How is that? That's crazy, right? No, that's actually depreciation. So guys, welcome to another episode of Everything Business. New time subscribers, thank you for subscribing. For those who are always coming back, thank you for always coming back. Please remember to like, subscribe and share. Today we'll be talking about depreciation, and it's a very simple topic. Let's get right into it. So what is depreciation? So depreciation is the reduction in value of a fixed asset, right? It is important for you to remember that we are talking about a fixed asset or a non-current asset. An asset may depreciate, which means lose value, right, due to wear and tear or becoming old and so on, like what you saw with the PS4, right? Depreciation is an expense to the business and will be shown in the profit and loss section of the income statement. Very important for you to remember. Now, there are two methods of calculating depreciation. We have the straight line method and we have the reducing balance method. We are going to be learning about these two methods because on the question, or on the exam rather, you may be asked to use any one of the methods or even both methods to calculate depreciation. So it is very important that you remember that, right? So using the straight line method, right? In this method, a fixed amount is deducted from the cost of the asset each year. So then if depreciation is $400, then at the end of the financial year, and it is important for you to remember or to note that depreciation is calculated at the end of the financial year, right? So at the end of the financial year, $400 will be deducted from the value of the asset, right? And that is the amount that will be deducted from the value of the asset under this method each year, the $400. So sometimes the value for depreciation may not be known in the straight line method, and if the value for depreciation is not known, then we should calculate depreciation in this method using the following formula, right? Cost minus selling price divided by number of years, right? So that is the formula that we would use in the straight line method to calculate depreciation if the depreciation figure is not known, right? And there are many different terms for selling price. You could say scrap value, you could say residual value, you could even say net book value, right? Or you can obviously say selling price. All right, so let's look at the reducing balance method now. Now the reducing balance method is where a fixed percentage is deducted from the cost of the asset in the first year, and in the first year only. Very important, guys. In the years after that, right, the fixed percentage is then calculated not on cost anymore, but on what? The reduced balance. Very important point, guys. So using this method of calculating depreciation, causes more to be paid for depreciation in the earlier years, and then it gradually gets less in the years after that. So in the reducing balance method, you will pay more for depreciation in the earlier years, and then in the years following, the amount will get less. All right. But let's look at a practical example. So a tractor is bought for $6,000. It will be used for 3 years and then sold for $3,072. Right? You are required to show the depreciation calculations for each year using A, the straight line method, and B, the reducing balance method with a rate of 20%. Alright, so let's look at the straight line method first. So remember, under the straight line method, a fixed amount is deducted from the value of the asset each year. Right? So the good thing about the straight line method, it is very straightforward. Pun intended. Right? Very straightforward. Once you get the depreciation figure, then that is the amount of money that will be deducted from the value of the asset each year. So you don't even have to do any other calculation. Right? If you are given the depreciation figure, you just know that that is the figure that you will deduct from the value of the asset every year. If you are not given the depreciation figure, like in this case, right, you will have to use the formula to calculate the depreciation figure. So you look at the straight line method here, we see we have the cost, which is $6,000, right? The first year depreciation is 976. But how did we get the 976? We use the formula, right? So the formula is depreciation equal what? The cost minus the selling price, which is 3,072, divided by the number of years that you will have the asset, which is 3 years. And it did say that 3 years, right? And that would be equal to 976. So that is how we get the 976 here. We subtract the 976 from 6,000, we get 5,024. Year 2, the value for depreciation under the straight line method, it's very simple. It is always the same. Once you get the figure, it remains the same, right? So year 2, the value for depreciation, 976. You subtract that from 5,024, you get 4,048. Year 3, same value for depreciation, 976. Subtract that from 4,048, you get 3,072. Now that is what we call the net book value. So at the end of year 3, the value of the asset will be $3,072. So you can sell it back now for $3,072. Alright. So let's look at the straight line method, the reducing balance method, guys. And the reducing balance method, you'll realize that they give a percentage, right? It's 20%. They may give you a percentage in the straight line method as well, but you just know, or you just need to know that once you find the amount for depreciation under the straight line method, it is that same amount you're going to use to deduct from the value of the asset every year. That is the key characteristic of the straight line method. Once you get the depreciation figure, it is that same amount that you're going to deduct from the value of the asset each year. The straight line method now, right? So we start with the cost here, $6,000. Right off the bat, you can see that it looks a little bit different in terms of how you do the calculations. So in year 1, the straight line, the reducing balance method states that the value of depreciation, or the percentage given rather, should be deducted from the value of the cost of the asset in the first year, and in the first year only. So the 20% is calculated on the cost, which is 6,000. So you're going to find 20% of 6,000, right, which is 1,200. So basically what you would do, you would type in a calculator 20 divided by 100 multiplied by 6,000, and you get 1,200. Alright, now in the years following, so you're going to subtract that from 6,000, 4,800 you get. Then in the years following, so year 2 now, you are not going to calculate 20% of 6,000 again, because that was the cost. In the years following, you're going to calculate 20% on the reduced balance, which is 4,800 now, right? Because the balance is now reduced, the value of the asset has depreciated, it now values 4,800. That is why we call it the reduced balance. So you're going to calculate 20% of 4,800, you will get 960. Subtract the 960 from the 480, you get 3,840. Year 3, you're going to calculate 20% not on 4,800 again, not on 6,000 again, but on the reduced balance, which is now 3,840, right? So 20% multiplied by 3,840, you would get 768, and you subtract that from 3,840 and you get 3,072. Alright, and that is the net book value. So the value of the asset after 3 years, right, using both methods, would be $3,072. It is maybe this is just a coincidence. You know, sometimes the methods can yield different values at the end of the period, and so questions may ask you to even give a reason why you would advise somebody to use one method as opposed to another method. You get what I'm saying? And if that question is posed to you, then you would choose the method that has the asset having a higher net book value at the end of the period, because obviously it means that they would have been able to sell the asset for more and get more money from when they're selling the asset. So for example, what if when we use the reducing balance method, we had gotten 4,000 here as the net book value? It would have meant that using this method to calculate depreciation would cause your asset to value more at the end of the period than if you had used the straight line method. You know, that is basically what I'm saying, right? So this is a coincidence that both net book value at the end of the 3 years are the same. So I don't want you to go away thinking that they have to be the same. If you are given both methods to use to calculate depreciation on an asset, they don't have to be the same, right? And if they are not the same, then and you're asked to advise somebody on which method to use, then you would choose the method that would give the highest net book value at the end of the period. So that's it, how to calculate depreciation. Join me in my next video for double entry for depreciation. Wow, good.